that I'll show you is a chart of India versus US. So what I have here is Nifty 500. What I have here, relative comparison to S&P 500. So if you look at this chart, India always follows a cyclical path in terms of outperformance and underperformance. Post 2024, and obviously if you plot this chart since 2000 or 1995 also, you'll repeatedly see that this is the pattern that India follows. A cycle of underperformance that lasts sometimes between 4 months to 12 months, then a cycle of outperformance again between 4 months to 12 months, and then again a cycle of underperformance. This is how Indian market have moved up. And if you plot the returns between India and US, India is the clear winner. I want to highlight this fact because of late, the government, Reserve Bank of India, has been doing a lot of things for the economy, and still you're seeing that the market digests that news in a day and starts selling off again. It is happening because all the good news in the market is coming within a larger underperformance cycle. Keep this in mind because this will come in handy towards later part of the video. So this cycle of underperformance, then there was a 4-month cycle of outperformance where Indian equity started doing well. And now again, we have entered a cycle of underperformance. The duration of cycles cannot be anticipated, but typically I've seen it is a down cycle lasts for about 6 to 7 months, whereas an outperforming cycle lasts as long as 8 to 12 months. The next chart I'll pull up is India versus China. Again, a lot of talk about this. Even in this, India follows a cycle of underperformance, outperformance, and now it is again within a larger cycle where it is underperforming Chinese equities. I'll again come back to this towards the end of the video because that is where I'll explain what is happening. The next chart I'll pull out is India versus larger emerging market basket. Again, same thing we are seeing, a cycle of underperformance, outperformance, and again underperformance. The next chart I'll pull out is India versus China in terms of performance. I've taken data since 2024 because before that, India was in a rampant bull market and China was nowhere. So we have seen this green line is NSE Nifty 500. This is China Top Security 300. So we were clearly outperforming in 2024, and then Chinese government infused a lot of liquidity with the help of central banks, and Chinese market just started taking off vertically in the month of September 2024. Ever since then, both were gradually performing together, and now we have again seen the Chinese market heading higher, up about 35 or 34% for the year, whereas Nifty 500 from 2024 is about 16% up. Chinese market last year were up 25%. Again, it is up 25% this year. What I want to highlight here is that China relatively has done extremely well over the last 2 years. But China is no longer that cheap as it was in 2024. See, market works on a principle of hindsight analysis. Most of the analysts who come out, including me also, we are all biased by hindsight 2020 kind of approach. When things are playing out in real time, it is very difficult to determine what is happening. It is only after that things have played out we can come to a conclusion that yes, it was China who was attracting a lot of capital and Indian markets were relatively underperforming. But this particular part has already played out. Yes, it is playing out in a bit at this particular moment, but it is not that China is that cheap when it comes to India. The next chart I'll show you is US market versus world. This chart is comparing the price of S&P 500 against the world ETF without US basket in it. So in the month of December 24, January 25, when S&P 500 had hit a new high at 6100, that time the relative outperformance of US was tremendous when you compared it with the world ex-US ETF. But now S&P 500 is at 6500. Look at the performance of US vis-a-vis rest of the world. This tells you within a larger bullish cycle that is playing out in the world globally, US market slowly is seeing outflows from US market into other world markets. This includes developed markets. It also includes emerging market. This is again an important point because emerging market is getting a lot of money. Other developed markets are also getting a lot of money. The only reason why India is struggling a bit is because India is underperforming the emerging market basket. It is underperforming China. It is also underperforming US. Again, why? Because this is a cyclical underperformance cycle that India is currently going through. And in this particular cycle, any good news that is coming in favor of the market is being quickly digested and the market is selling off. And when I say market is selling off, let me tell you that does not mean market is bearish. Market goes through a period of up and down. It is just that there is a lot of euphoria when market moves up. There are a lot of participants who come in the market and they get that dopamine effect that you get when you go to a casino or you're playing these fantasy apps kind of thing. And when that goes away, just like a drug hits you, when the withdrawal happens, the current phase seems a lot more bearish in market terms than it actually is. So it directly impacts your mood, it impacts your sentiment, and it also clouds your judgment in terms of analyzing what is currently happening in the market. Till now, there are three things that we have established. Number one, India is underperforming the US, it is underperforming emerging markets. And this is a cycle that keeps repeating often. And US currently is also underperforming the world. India is also underperforming China. For foreign investors, you have to understand that India and China are the only two main emerging markets that are there to invest. I'm talking about the size of emerging markets. India and China are the only markets that qualify. And China, of course, is no longer cheap because it has caught up in terms of performance. Now, why China may never overtake India in terms of stock market performance is because if you look at the charts over long run, over 5 years, 10 years, 15 years, India hands down outperforms China in the long run when it comes to equity performance. The number one reason being that in general, our companies have lesser debt, they have higher ROEs, and they have better profit margin. And ultimately, price is a function of earnings and PE ratio. This is why Indian markets, I'm only talking about Indian stock market. I'm not talking about the Chinese infrastructure. I'm not talking about China as an economy. I'm talking about Indian stock market. Indian stock market historically has delivered unbelievable returns when you compare it with China. In future also this is going to happen. Because stock market in general relies on corporate governance, it relies on better margin, it relies on lesser debt, it relies on higher ROE and ROCE, and Indian companies in Asia, even if you compare with America, are one of the best when it comes to investors, the matrix that is seek out in terms of investing in stock markets. So don't get too bearish just because India is currently seeing a cycle where it is underperforming emerging markets, it is underperforming US. This is just a phase, and this phase is going to go away. The next thing I'll pull out is some practical tips that I have gathered over the years in some books. And I've seen a lot of these things playing out in real time also. The first is, you must have read in many books, don't fight the Fed. In Indian context, it would be don't fight RBI. I'll just read out a couple of things. If central banks are supporting growth, never fight it. Things don't have to work immediately, but pick up in economy will happen. The second is don't fight the government. Again, in many US books, I've read it. What is the government doing today? If government is hell bent on pushing for growth, don't fight it. Your bias doesn't matter in terms of whatever we see day-to-day basis at the ground level. Because remember, stock market does not work that way. Stock market, as I mentioned earlier, is a function of, that is, price is a function of earnings and PE ratio. That's it. Keep it simple. The day you start thinking this way, a lot of things will start making sense. So government and the central bank together can turn economy in couple of quarters. And look at what the government has been doing. Look at what RBI has been doing. Third, there is a distinctive shift. Now, this is something that is happening in real time. From government point of view, earlier they were focusing on higher tax rate and lower base effect. That is, lesser number of people paying higher taxes. Now, this certainly has not worked. And a lot of people were giving this feedback to the government. We have also discussed this many times that at the ground level, things have to change. And finally, I think government has realized the mistake. And they have now shifted to a lower taxation but higher base approach. And yes, mark my words, GST collections are going to shoot up. There won't be any major shortfall in GST collection as it is being reported. There won't be any impact on fiscal deficit. Because if you study historical data of various countries, this is what happens. When larger number of people, and thankfully India is a country of 1.4 billion people, come forward within a low taxation environment in terms of daily goods and services, then the base effect, that is the number of people itself and the volume of consumption, supersedes any potential revenue loss that is going to happen to the government. Yes, it can happen for the next 2-3 quarters, but let's come back and revisit this about 15 months down the line. The last part that I'll cover is stop being obsessed with FII data. I'll explain this in a bit. Now, obsession with FII data will lead you to premature exits. You'll start thinking FIIs are pulling out money, market is going to fall. It will lead to loss of conviction. Yes, I totally understand FIIs are important, but make sure you compare apples with apples. What do I mean by this? If you look at the FII data and the amount of analysis that goes around this, how much you have to ask do FIIs hold in terms of Indian equities? If you go through some data, that number is roughly between $789 billion to $825 billion. This is the amount of equity in monetary terms that FIIs hold in our equity markets. That is $800 billion. Let's settle for a round figure, $800 billion. In 2024, FIIs pulled out about $7-8 billion. Their net figure was positive, but I am taking data since September also because that is when correction actually began in the market. And if you look at the 2025 number, FIIs till date since September 2024 have sold somewhere between $25 to $30 billion. Now, how does this number, let's say it is $35 billion, how does $35 billion measure up against $800 billion? Next time when you listen to the hype around day to day FII data, keep this in mind. They are not exiting India in terms of pulling out all of their allocation. A part of their portfolio they are pulling out. Maybe 10% they'll pull out. Is that really negative for the market? No, it is not, because thankfully our domestic investors are stepping up and the mutual funds and entities are getting massive inflow and we are able to absorb this selling. This does not reflect weakness. It reflects maturity in stock market that wasn't there in 2003, 2008 bull market. It wasn't there in 2010, 2019 market. For any of you who were active during 2010, 11, 12, 13, 14 phase, the day or the month FIIs used to pull out 3,000 crores or 4,000 crores from the market would be down 8 to 12%. How much does the market move today? Negative 2, 3%. This is strength. This tells you that fundamentally our markets have changed a lot. And instead of obsessing about FIIs pulling out money on a day-to-day basis, look for opportunities where domestic institutions are buying these data. It's just not difficult to get these data these days. So have a different approach. Always ask yourself, let's say you and I were FIIs in India and we had net investment of $50 billion. If we pull out $5 billion from India, are we bearish? No, we are not. We just as an economy have to work harder to attract more capital. And perhaps that is what RBI and Government of India realize. And whatever they are doing, hopefully FIIs will start coming back in the year 2026 or maybe a couple of quarters in 2026. The next slide, again, where are we heading? So this was the last slide I had updated, that a retest of 200 DMA is possible. We may even go lower. I don't know that. It's very difficult to say these things. We are, I think, somewhere very close to it. And I only see a sustainable rally developing in Indian markets in the year 2026. As we get closer to September, October, I'll tell you whether February, March is the month where we begin a sustainable move or closer to April, May. That is something I cannot tell you today. So the key takeaways is that government and RBI are working towards pushing growth. I've read several books. I've read several letters from Warren Buffett, Charlie Munger, some other great, fantastic investors out there, Jim Roppel, Mark Minervini, William O'Neill, Stan Weinstein. They've all mentioned this. Never, ever fight the government and Fed. That is, they said in US terms. In our terms, it is government and Reserve Bank of India. Never fight these two entities. If both of these are bullish on the economy, look for long-only opportunities. Yes, things don't have to work immediately. This is stock market. This is not a slot machine. This is stock market. This is not your fantasy app, the sporting apps that were just banned. Things take time. India is no longer the 15th or the 20th largest economy in the world. We are among top 5 economies in the world. It is obviously going to take time to turn it around, but be bullish. And I don't like to give out if or else kind of opinion. I am super bullish on our stock market. And I am buying gradually whatever and wherever I feel the opportunity is. So the recent GST reforms have brought in 2 more sectors that are seeing a lot of fillip, that is auto consumption and FMCG. Within this also focus on new age companies. EV sector is a big theme, focus on it, batteries. These things are going to grow. And my top picks, I'm participating in these as I updated last time through ETFs only. I still haven't started picking out stocks a lot. I'll just wait for some more time. I don't like chasing. So whenever these sectors begin to fall, that is the only time I'll start looking into them. But apart from that, my top picks are still financial services, metals, insurance, hospitals, defense, and capital market. Capital market and defense and hospitals. In my view, this is a massive opportunity that is there for the next few years, and I would say maybe 5 to 7 years. Defense, capital market, hospital, insurance, because you can just see at the ground level what is happening. This is a massive opportunity. It is just that you have to be patient during corrections. You have to be patient, keep accumulating slowly the companies you understand. It is not difficult. If you don't know how to pick stocks, there are ETFs for every single sector. There's an ETF for financial services. There's an ETF for metal. There's an ETF for defense. There's a healthcare ETF. I don't think a dedicated insurance ETF is there, but I'm sure it must be on the way. There's a dedicated ETF for capital markets also. And there is a dedicated ETF for FMCG consumption and auto. There's never been so many ETFs that has made participation so easy in markets. So pay attention, be bullish, have your risk management rules in place, because at times what happens, markets can give you a massive shakeout and then markets start heading higher. So your risk management rules are paramount. But don't be unnecessarily bearish on the market just because FIIs are pulling out money, or supposedly there is a lot of talk that valuation is really, really high in the market, which I completely disagree with, or the earnings growth are just not there in place. So it's a tough phase in the market, nothing that we haven't discussed earlier, but during tough phases is when you look for opportunities. If you start looking for opportunities when things are heading up, the only thing that you get in return is frustration and underperformance of portfolio. So have a great weekend ahead, guys. Take care and be safe.